sugar. Oh, I'm live now. I'm so sorry. I started. Am I live now? People can see me? Okay, fantastic. Okay, so sorry about that, everyone. Ran into a little bit of technical difficulties at the start there. I thought I had started it, but it turns out you didn't. So has the bank blanked my wife? Thank you for putting your comment. Otherwise, I probably wouldn't have known to click that start button. So you should be with me now. So thank you so much for joining me. This is really like the open window session. I had a few viewers drop off. I need to be a little more punctual. I had some technical difficulties at the start. So I'm still new to this whole streaming thing, so hopefully you'll bear with me. And this is recorded and it will be posted on YouTube later in case there are anyone who missed it or who came and dropped off. They'll be able to watch it after the fact. So really my game plan for tonight is to be here to answer your questions, to go through a whole bunch of different things. What I'd like to do is start just by showing you kind of the state of the markets, the different things that I'm looking at right now. So I tend to look at Yahoo Finance is the source that I get sort of my free research. I can see here, Toronto stock market, 3.5%, 4%, yes, I'll take that. And the S&P 500, 0.5%. At this point, I would call this flat for a day. And oh my goodness, I'm so happy to have a flat day in the markets. It didn't feel like there was any panic. It also didn't feel like there was huge greed. It actually felt like a somewhat normal day. So I'll absolutely take that. Another thing that I do tend to keep an eye on when I'm looking at these different prices is in the performance of the market is I do tend to look at the price of oil is something I'm following quite a bit right now. So here we've got WTI, West Texas Intermediate. So this is the sort of the benchmark for oil globally. You can see here right now, oil, WTI is trading at about 25 bucks a barrel, which is very low. Historically, over the last little bit, it's been about between 50 to 60 bucks. And then you can see basically at the end of February, it just fell off a cliff. Now it has bounced back a little bit, right? And this is going to be in real time. So it's going to be sort of as of the end of day kind of thing, that these are probably the futures market, that this will keep trading through the night. But that you can see here that the price of oil is just down so far. Based on everything I'm reading, Alberta needs a price of oil at about 55 bucks a barrel in that ballpark in order to break even. And we haven't had that really since January. So this is a big problem. I don't think too many people are following this right now. But certainly something I'm keeping my eye on is the price of oil. That's going to have a huge impact on Canada and certainly in Alberta. Fortunately, for a lot of my clients, we don't have any fossil fuel stocks, which is great. We've missed out on a lot of that decline. Although obviously it could bounce back, so we'll see how it goes. I often tend to just kind of look around to see, how things have done today. So one of my favorite green ETFs is PZD, the clean tech ETF, right? It was up 2.5% today. Great, I'll take that, no problem. There were a couple pops. One of them, ETHI.to, sustainability leaders, did kind of jump up a fair bit. Now I think this might have been because the pricing was a little bit off at the end of day yesterday. But you can see, back up to, it sort of has bounced back quite a bit over the last few days here, which to me, again, I'll take that. I don't know if it's going to last, but it's nice to see that. I also did see Hannon Armstrong, which was one of my top picks on BNN in the past, that's up quite a bit today. Again, you can see it has fallen a lot over the last little bit. And so you can see it's got this really nice fat dividend here. Use this as an example if we do want to dig into individual companies, kind of how I would take a look at the debt levels and kind of can a company survive this. So, always interesting to kind of have a look around at the markets to see what things are doing. These are the types of things that I tend to look at, especially after hours once the market is closed. Honestly, I'm kind of trying to avoid looking at it too many times throughout the day. It can be a little bit addictive. So my favorite thing is to once markets close and it's done for the day, that's when I can kind of make the assessment of how the day's gone. So let me jump into the chat, see if there are any questions here. And, if there are questions, please just put questions in here. If there aren't too many questions, it can be a short session. If there are questions, then I'll handle them. I'm happy to stick around as long as we want. From there, what we're going to do is, that really I'm kind of counting on you to help me create this content. So I've got some ideas for things that I can do, but, obviously if you've got questions, then I do want to see them. So, first question here from Vincent Young. Thanks again for doing these open windows, Tim. My pleasure. Sorry, I was a little late today. Curious why you haven't switched over to Wealthsimple Trade platform, considering both buying and selling is free. So you were probably watching yesterday as I tried to rebalance my portfolio and was very unsuccessful since we hit the circuit breaker and I was unable to do any trading at all. So basically, Wealthsimple Trade does offer free buying and selling, which is awesome. I love the fact that they do that. Questrade, what really appealed to me was the fact that Questrade let me buy ETFs for free. With Wealthsimple Trade, I think you can buy both ETFs and individual stocks. You can both buy and sell for free, which is awesome. So the big reason why I haven't switched over, I don't want to have to do the paperwork and switch things over if I don't have to. Generally speaking, I'm really happy with Questrade. That I don't plan to be selling ETFs very often. My plan is just to put money to work and buy ETFs as much as possible. So the other reason why I'm with Questrade instead of Wealthsimple is because the fact that a lot of my holdings are in US dollars. My understanding is that Wealthsimple doesn't allow you to have a US dollar account, which means that you're not allowed to do things like Norbert's Gambit. And what they do is they do that currency conversion for you whenever you're buying or selling US dollar things. Also, when you're receiving dividends in US dollars, they'll convert them over to Canadian dollars for you automatically. And that they will take that little 1.5% fee when it comes to that currency exchange. So that's how they make money. Hey, Wealthsimple's got to make money. I'm super cool with that. That said, for me, because so many of my holdings are in US dollars, I think it will make sense for me to stick with Wealthsimple for now. But I love the interface, it'll make sense for me to stick with Questrade for now. But I do love Wealthsimple's interface. It's really quite beautiful. It's really simple. And I'm really glad that they are competing on fees. In the US, we've seen a fair few of the online brokers move towards zero fees. And I would love to see that competition here in Canada. So I really support what Wealthsimple is doing with the Wealthsimple Trade platform. It just doesn't make sense for me right now. Although, if they offered US dollar accounts, then that's something that might entice me to switch over. Okay, so I've got a question from Steve Higgs here. Okay, so can I speak to why some ESG ETFs might hold companies such as pipelines, energy, or mining? I'm looking at the iShares Jancy Social specifically. Okay. This is a super cool question. iShares Jancy Social Index. This was one of the first socially responsible ETFs in Canada. So it's xen.to is the Jancy Social Index. So this one's been around for quite a while. I don't know if it'll give me the, here, let me actually just bring up the website itself. I'll get it from iShares, or in this case, BlackRock.com. iShares owns BlackRock owns iShares. So sometimes it's BlackRock.com. The US site, it's iShares.com. But in this case, because this is Canadian dollars, we're going to look at here, which is the iShares Jancy Social Index ETF. Oof, down 33% since January 1st. Not pretty. Okay, so basically, this is one of the first socially responsible ETFs in Canada. You can see here it launched May 2007, which is huge. This is, so long ago in the world of ETFs. This is one of the oldest ETFs, certainly when it comes to the socially responsible and ESG side of things. As you mentioned, when we look at the holdings, there are going to be a lot of things in here that people don't love. CNR, the banks will be in here. Then I actually have to scroll down quite a bit now to see Suncor. It used to be quite higher on the list, but Suncor has fallen quite a bit. I can click on show all, and there will be some pipelines in here as well. Here's Pembina, right? Different. Here's Imperial Oil. So obviously there are fossil fuels in here. When I look at the sector breakdown, you can see energy. It's again a lot smaller than it used to be. It's amazing to me how much this has fallen over the last month. But energy does still represent about 7% of this ETF. So obviously for people who want to divest from fossil fuels, this is not a great option. This just, it's not going to be great. So the reason why it's in here, let's see, I don't know if they're going to have it here. I think I need to go, and if I do Jansi Social Index methodology, I know it pretty well, but I want to be able to show you exactly what it looks like. So Jansi refers to Michael Jansi, who is the founder of Jansi Research. Jansi Research eventually merged with a firm called Sustainalytics and took over the name Sustainalytics, although Michael Jansi is still the CEO, he still runs the company. So the Jansi Social Index, that's interesting, hasn't been updated for a little while. I wonder if there is a more recent one. Let me just check on their website. Sometimes Google's not the best at giving me the most up-to-date one. So let me just see here if they do have a more recent methodology document. Oh my goodness, they want my information. Okay, let's do this. President, research, I don't know, company, sustainable, economist, countries, Canada, oops. Oh my goodness. Sorry for this. Let me see if I can get it quick. I agree. No, I do not want that. Submit. Okay, great. And then now it should take me. Here we go. Oh, June 2017. I get an extra year. There we go. Okay, so basically what they're going to be doing is this is a market cap weighted, right? And consisting of 50 companies that pass a set of broadly based ESG screening criteria. So again, this is this idea of ESG, environmental social governance. Really what they're going to do in this case is they are going to get rid of what we would call like sin stocks. Because this is one of the oldest funds, it does adhere to these sort of more religious exclusions. So military, nuclear power, because when a lot of this stuff was created, it was sort of, people were more worried about nuclear power than they were about fossil fuels. Again, I'm not arguing for it, I'm just telling you why that is. Tobacco, and then from there what they do is they do the ESG. And so to include companies with leading sustainability performance. So what they do is they remove companies whose ESG performance is lagging and add companies whose performance is leading. My understanding is that really what they're trying to do is dump the bottom 20% of companies within a given sector based on that ESG score. And then this is the key point, is really what they're trying to do is maintain sector weights close to the TSX 60. So if you don't know what the TSX 60 is, this is a very standard benchmark index. You can see it's like the one that's at the top here. This is the composite index, but I think it's XIU is the TSX 60. So this is going to be like the 60 largest companies in Canada. I could get all the holdings, but this is going to have all the major companies in here. What they're trying to do is really have these same sector weightings. So, if we look at it, financial services, right? Now this might be a little bit old, so which is why energy is higher than it is. But really what the Jansi Social Index is trying to do is to mimic this index while getting rid of the sin stocks and getting rid of the worst of the worst. Because of that, they don't classify fossil fuel companies as sort of sin stocks. That they're going to be in here. However, they're going to get rid of the ones with the worst ESG scores. So when I look up a company like Suncor, and again, I can look it up on Yahoo Finance here, and there's now this tab that says sustainability, and here's where it gives me Suncor's ESG risk rating. Now, in this case, we want a low score. The higher the score, the worse they are. So again, we could look up some of them. But in this case, Suncor is in the 43rd percentile. they would be much higher than something probably like Husky Energy, right? You can see Husky Energy, very, very high risk, high environment, high social, high governance. Whereas when we look at Suncor, still high environment, but lower than Husky, lower social, lower governance. That's why Suncor is still going to be inside this index. Now it is interesting because we can look at the TSX 60 and find out which companies have been omitted. So when we look at the big banks, RBC, TD, BMO are in here. No Scotiabank, no CIBC in here. That's interesting. Likely what that tells me is that Royal, right, 19th percentile. Hey, not bad. TD. And again, I'm not defending these scores. I'm just pointing them out. 27th percentile. BMO, which was also in there, right? 26th percentile. My guess is that Scotiabank, here it is, BNS, has a higher. Yeah. And this is interesting. And again, this is 32nd percentile compared to the broad stock market. Whereas really with the Janssen Social Index, they're just looking at the financial sector. And whereas something like CIBC, are they gonna, yeah, here it is, no, Canadian, I don't think it's any of those. Canadian Imperial, here it is, cm.to. Again, 32nd. So that's why, there are going to be fossil fuel companies in here. One thing that's not in here that often is an interesting case study is Enbridge. Now, they do have, it's not a great ESG score, but they also have had controversies. I know Enbridge had a big oil spill in the Kalamazoo River. So if there is a major controversy, I think it's in the methodology where they will get rid of things based on, delisting, financial distress, mergers takeover, spin-offs, and then they do have this index committee. So if you want to get upset about why these things are still in there, I would suggest you to reach out to the index committee. I don't think there's anything else in here, no. So that's why they're in here, lots of interesting things to look at. Enbridge compared to something like Pembina, right? And you can see here, it's interesting to me, Enbridge has a lower score, right? But for whatever reason, Enbridge is not in here, and I believe Pembina is. So again, there is a little discretion in here about kind of how that works. I think that would be up to the committee. For some reason, they would have decided that Enbridge was just a no-go, maybe based on the controversy or something else. But really, that's why fossil fuels are inside so many of these ESG ETFs, is because they're looking at this sector breakdown and they're trying to mimic the standard benchmark. And unless it specifically says fossil fuel free, energy at zero, they're all going to include energy. They're just going to get sort of the best in sector, or in this case, remove the worst in sector. I'm hoping that's helpful. Let's see if there are more questions. Okay, great. What are your thoughts on holding, I just saved you research time. Awesome. I'm so glad. Super cool. So, okay, Jeffrey Singer here. What are your thoughts on holding DRCU for the bond portion of the portfolio? It integrates ESG considerations, includes corporate as well as government bonds. Okay, so let's look it up. DRCU, I know this one. This is the Desjardins ETF. So they released a whole slew of socially responsible ETFs. So this would be DRCU here, which is the active Canadian bond ETF. So it is going to be a mix of federal, provincial, and corporate bonds. Really, I would say the flag for me on this one is going to be the fee. At 0.41, there are going to be some cheaper bond ETFs on the market, even socially responsible. So I'm happy to show you what those are. But, that's kind of going to be my issue with it. When we look at what's actually inside of it, we should be able to see here that it's about 42% corporate, about 27 is the federal government, and about 26 is the provincial government, which is awesome. It is going to be a mix, as I expected, a mix of short-term, medium-term, long-term bonds. Fantastic. And we do get the credit ratings. So AAA, these are going to be Government of Canada. From there, it's interesting, they split it up, AA plus, AA minus, same thing here. And it's going to be these triple Bs. These are going to be some of the corporate bonds, a little bit riskier. That's what they are. When we look at the holdings, you know, it should be the government bonds, or these would be crown corporations, are probably going to be at the top of the list, which is why we're going to want to download all of them just to be able to see what's inside here. Let me just go all the way here and let me make it a little bigger. Hopefully you can see it. So yeah, when I go through it, you know, here's Bank of Montreal, TD. I'm kind of looking to see if there are fossil fuels in here. That to me would be interesting. 407, here's Enbridge. So again, pipelines will be in here. You know, it's not a huge percentage, at least this one bond, but there will probably be others in here as well. I'm curious to see if there are going to be any tar sands. You know, something like Suncor. Here's Pembina Pipelines, Enbridge. Let me do a, that's it, okay. John Deere. So I'm not seeing any specific oil and gas, you know, the extraction companies. I am seeing a fair few pipelines, which for me would be cause for concern. Now, if it's a combination of natural gas and oil, they're going to be better positioned. But, you know, they are oil pipelines. I mean, you know, I think it's let's see how this price of oil stays. But I think that we could see some issues there. So really what I want to look at here, if we're okay with the holdings that are inside of it, what I want to do is come back and see if I can get something called the weighted average coupon. It's usually under the overview. So there are a couple different ways we can measure the expected returns. There's the weighted average yield to maturity, 2.37%. This is what I would expect to be sort of like the low ball of what kind of yield or interest payment I would expect to earn. And then here's the weighted average coupon. This is going to be sort of like the high ball of what I would expect to earn. These are different ways of measuring that expected interest payment. The distribution yield is kind of going to be in the middle. But I would expect to earn somewhere from 2.37 up to a maximum of about 3% per year from this. And so again, you know, paying that management expense ratio of 0.41, it's a little on the pricey side. The one that I do know is a little bit cheaper is XSAB.to. So this one was released by iShares BlackRock a little while ago. It's going to be very, very similar in terms of what's inside. You know, provincial, federal, and then again, you know, corporate stuff. This one a little more on the government side, so closer to like 70, or in this case, it was almost like 73%. Whereas, you know, I think the Desjardins one was closer to about 60% corporate bond. Yeah, or sorry, about 40% corporate bond instead of about 27% here. But again, you know, this is going to have some pipelines in here. I have gone through this one. I do know I can sort here by corporates, and I know, you know, here's TransCanada. And I know Enbridge is going to be in here somewhere as well. Here it is. So again, there are pipelines if you're looking at corporate bonds. That's going to be in there. In terms of the maturity, again, a mix of short-term, medium-term, long-term. And the credit quality should be sort of in a similar ballpark. A little more AAA compared to the Desjardins one, so maybe a little bit safer. When we look at the returns here, again, weighted average yield to maturity, here it is, 2.08, so a little bit lower here. But the weighted average coupon, 3.2, so a little bit higher. So a little bit of a bigger gap there, you know. But again, returns are going to be fairly similar. And then really for me, it is the expense ratio. Where is it? Is it the holdings? No, it should be here. Here it is, 0.2%. So to me, like, you know, they are fairly similar. So I have no problems with holding this one. What's interesting is that this does use an active management approach, which is why it's probably a little more expensive. You know, I will be interested to see in terms of the carbon footprint. I have been able to get that information from Morningstar, although, hold on, it's been a little bit funny lately with the URL. It doesn't always like it. Sometimes I have to go to this one. There we go. But that basically, oftentimes I can get the carbon footprint through Morningstar, although I haven't been able to with bond ETFs. So I'm going to just try here, xsab.to, and just to see whether I can get the carbon footprint of this portfolio. So here we go. No, it's not giving it to me. Darn it. I really hope that they update this to be able to include DRCU, to be able to include bond ETFs. For whatever reason, I can get the carbon footprint for stock ETFs through this website, but it's not giving me any data at all. Darn it, for the bond ETFs, too bad. So anyway, hopefully this kind of gives you, I've got no issues with this. If you don't want pipelines at all, that's when we would move to a government bond ETF. But otherwise, I would say it's kind of between this Desjardins one and the iShares one. I'm cheaper, so I would probably lean towards the iShares one. Although if you wanted a little more exposure on the corporate bond side, you know, the Desjardins one does have that slightly more corporate bond exposure. Hopefully that's helpful. Let me just go back to the questions here. Here we go. Okay, awesome. Wicked, can I talk about the pros and cons of using Passive or other automated tools for rebalancing? Okay, so Passive is a really cool tool here. When we talk about Passive, you know, really what this is doing is they call it autopilot for your portfolio. So this is a great tool. I love this tool. I've got some clients on this who just absolutely are thrilled about it. What it allows you to do is to set up your target portfolio. So you can punch in the ETFs that you own, and then you can use these little slider bars to be able to set your target portfolio. It's going to link to your Questrade account. My understanding is this is only available through Questrade. I think also Interactive Brokers they added here in Canada, which is kind of cool. But what this allows us to do is to monitor the accuracy of our portfolio. And then they do have this elite membership plan, and Questrade clients get the first year for free, which is awesome. And really what this would allow us to do is to have multi-account portfolios. So Duncan, like in your case, like with you and your wife, we could connect both of your Questrade accounts to this. It would look at that breakdown across both of your accounts, which is fantastic. As well, what it'll do is allow for one-click trades. So if you want to rebalance your portfolio, what you would do is prepare all of the trades, and then it would be like, okay, click here to set up your orders. Now, it'll only do it while the market is open, and certainly not if circuit breakers are active, but it will allow for these sort of one-click trades, which makes the rebalancing process so much easier. In terms of trade-offs, so obviously $80 a year, not a big deal, and especially for people with a larger portfolio, $80 a year is like not very much. So to me, that's not a huge issue. Really what it comes down to in my mind is the complexity of the portfolio. That if you have all of your holdings in like one account, then great. This is like the easiest thing ever. Like if you have ETFs inside of one TFSA, no worries at all. Where it starts to fall apart a little bit, or it doesn't fall apart, but it's just not going to be optimized, is it's not going to let us optimize for tax efficiency, right? So in terms of holding things in the RSP versus the TFSA, it doesn't always do that. It's not, you know, I can't quite have the settings, or maybe I just haven't set it up right, but, you know, I'm having a hard time saying buy this in this account. As well, I am struggling when it comes to the currency conversion. That although it does allow us to sort of like keep currency separate, so if you wanted to do that and then you do Norbert's Gambit manually, you know, it doesn't allow for that sort of like a automatic conversion. That either your choice is to let Questrade kind of like do the currency conversions for you and pay that 1.5% conversion fee, or you kind of would do the math, have to do Norbert's Gambit on your own, and then sort of click that rebalance button. So those are the two things where I wish there was a little bit more functionality, is being very specific about this ETF, I only want to buy it inside of this account. That would make my life easier. As well, if it did like in a magical way do Norbert's Gambit for us, right? That obviously I don't expect them to be able to code that into it. But you know, there is going to be a little bit of inefficiency there. So really what it comes down to, Duncan, with Passive is that, so number one, I would suggest, because I know you've got the fossil fuel free portfolio, so just to show other people, I've got these different model portfolios, and I'm like 98% sure that when we worked together, it was still, we didn't have these fossil fuel free ETFs. So we did something, you know, based on the original fossil fuel free portfolio, which was much more complex. So using an app like Passive would be way easier if we're doing something like the Easiest Pie portfolio, where there are only a few holdings, or for something like the Squeaky Clean portfolio, where there are only a few holdings, right? So we might want to do a little like spring cleaning to get your portfolio a little more simple with fewer holdings. And then as well, what we would want to do is I would suggest like get some practice with it and like use it, but also be aware of how it might not be fully optimal. And then from there, kind of like make the decision, so get Passive to like do the math for us. But then we might actually end up, sort of tweaking things a little bit in order to keep your portfolio tax optimal and sort of currency optimal, just to be able to save those little nickels and dimes here and there. So, it's really suitable for people who have more simple portfolios. If you've only got one or two accounts, if you've only got a few ETFs, then this is like so awesome for you. Really the downsides of it are going to be the tax optimization, the currency handling piece of it, that, it starts to, the robot, doesn't quite let us do exactly how I would do it. But if you don't really care about those nickels and dimes and you're just like, Tim, I just want to be able to rebalance without a bloody, Excel spreadsheet, then obviously this would be a really good option. And again, what's awesome is that because it allows you to have a free year, what I would suggest doing is like try it out. Is to do it, to link it. I can help you get it set up. We can input all of your different ETFs on here. We can simplify if you want to, or we don't have to if you don't want to. But let's do it. Let's see how it works out. And then really this is about finding the rebalancing method that works the best for you. Hopefully that answers your question. By all means, if you've got more question, I'm so happy to be able to answer it. Okay, sweet. So let's see it here. Willing to give any commentary on BEP versus Northland Power? Waiting to start a position, but having a hard time choosing between the two. NPI equals more debt. BEP equals lower recent return on equity and revenue growth. So, honestly, Steve, I think you've sort of nailed it in terms of these questions, the analysis there. Let me just show people what we mean by debt, because I think that's such a helpful exercise to be able to understand. This is something I'm really looking at. Starting to, get my shopping list together to see if there are things I want to buy. I do expect this to be a bit of a prolonged, I don't know if I want to use the R word right now, but, maybe a little bear market or something like that this thing could draw on for a little while. So what I'm looking for are companies that are in really good financial situations. In the last crash in 2008, 2009, cash was king. Credit markets got frozen, and we wanted companies with a lot of cash. So let's look at Brookfield Renewable. We can look at their financials. We're going to look at their balance sheet to be able to see their cash and liabilities. I can see here, let me just zoom in a little bit. Hopefully everyone can see this. Their total cash, and now this is going to be USD in thousands. So they've got about 115 million in cash, but they do have a lot of net receivables here. So when I look at sort of the current assets, that's interesting that it's, normally these numbers would add up to current assets, but, I would expect this number to be right. They've got about, $1.4 billion in current assets. From there, I want to look at their liabilities, which is their debt. And so their current liabilities, about 1.6, and then long-term debt, about another 10 billion here. Right, so I can see here, total liabilities about 17 billion. Is that right? Compared to deferred revenues, long-term debt. Yeah, that looks right. And they've got about, they've got quite a few here, the property, plants, and equipment here. But what I'm seeing here is that they're in a decent state here, but obviously with quite a bit of long-term debt here. From there, hold on, is this the right company? Yeah, that's right. And then if we look at NPI, let's take a look at them. And again, we've got their balance sheet right here. So they're in a situation where, again, about 1.2 billion here. And let's look at their liabilities. I think this is sort of what you were talking about here. Is, about 8, about 6.5 billion in long-term debt. So that's interesting to me that, that Brookfield here, it does look like they've got more long-term debt. I'm just going to check the chat. Do I have that right? I just want to see here. Steve, let me know if I'm right on this, that NPI more debt, and it's probably you're talking about the ratio. So it might be relative to, and I'm going to let the stream catch up, it might be relative to their market cap compared to their cash. Would that be right? Oftentimes what we'll do is look at their statistics, and we can look at some of their valuation metrics. So when it comes to these, a lot of them, price to book, this is the book value, is the value of their assets. So again, we're looking at Brookfield here. Price to book of about 2, which is solid. It means that the share price is trading at about 2 times the value of their assets, which is just fine. And then we will have some, here we go, cash here, total debt 11 billion, right? And then from there, if we were to look up NPI, NPI.to, we can look at it here. And again, in terms of their cash, so first let's look at their price to book, 5.4. So this tells me that Northland, compared to the existing projects, would be considered like more expensive compared to their existing projects. The investors are paying sort of a higher multiple compared to the value of their projects. Total cash, 268 billion. Total debt, about 7.8 billion. Right? So, and again, everything should be like relative to the size of the company, which is their market cap. So again, NPI 4.6 billion. Brookfield is a lot bigger. So I'm seeing here it's about twice as big. So I'm guessing when you say, NPI has more debt, that they've got more debt relative to the size of their company. And I would agree with that. So I think that's sort of like what you're talking about there. In terms of the earnings, the way I look at it here is now these numbers are going to be really misleading, because the goal for a lot of these utilities is not going to be to produce earnings. It's going to be about paying dividends. So in this case, Brookfield hasn't been, earning a lot of profit, but I think that's because they've been giving so much of their cash to dividends, or to investors through the form of dividends. Now I can see that they've been missing some estimates, which is not a great sign here. The Brookfield has missed a few there. And then NPI, if we look at them, right? Again, you're going to see better earnings here. You're like, whoa, way much higher earnings. But that tells me that they're probably not giving out, maybe quite as much of their cash in dividend, but they have been beating the estimates, which is why there's a good chance that NPI's share price has been doing a little bit better. The cool thing about NPI is that they are, I would say, the last time I looked at them, Northland Power, is that they have been a little bit more aggressive. That basically what they've been doing, and both of these companies are renewable energy utilities, but my understanding is that if we can look at their operating assets, let me see if I can get like a map of the world, that I think Northland has been a little bit more aggressive in terms of expansion. I just want to see here, these are going to be in the Netherlands, wind projects here, and then most of them are in Ontario. I'm wondering if I might have gotten it mixed up with a different company. Offshore wind project, new CFO. I feel like this is right. And then let me just see here. I just want to see if they have maybe upcoming development projects. This is probably what I want to look at. In development. So yeah, so these are the projects that they've got sort of that are in development. So this is like a pumped storage hydro facility here under construction. These looks like the wind projects there. So these are the things I would want to keep an eye on, are the projects in development. You can see here they have not secured a power purchase agreement. So this to me is going to be sort of like the red flag looking at this, because what it means is that, really my fear is that if they don't have the construction, or sorry, if they don't have the PPA, then right now energy usage, I'm expecting it to be a lot lower because of the slowdown. Now, in this case, it's really just the pump storage project that's in development. So we'll see how, how the Ontario government and, whether they still want to move forward with these projects. It looks to me like if it's under construction, this suggests to me that they do have a long-term PPA, but that's the type of thing that I would want to check. In terms of Brookfield, I don't know if they've got as many Brookfield Renewable. I don't know if they've got as many projects under development. Let's see. So what I would want to look at here, their website's a little bit funny, but I think I know where to look. Again, what I want to look at, so these are the different projects. What I want to see is whether they have any under development. I don't think they're going to tell me. I think I'd have to sort through their latest annual report to be able to see exactly what they have under development. This is installed capacity. But my understanding is that, they don't tend to develop them as much, that they tend to wait for them to be built and then purchase them. So, straight up, if I had to guess, I would say it's a bit of a coin toss, maybe own a little bit of both. I'm comfortable with both of these. But what I would say is that for me, Brookfield, the fact that it's trading at the lower price to book ratio, when we did look at the statistics, to me suggests that, that this Northland Power is a little bit more expensive right now, given the book value of their projects compared to Brookfield, which I think, and trading at a price to book of 2 right now is probably a little bit more affordable, given the value of the projects that they do have. That's my take. Obviously, do your own homework, do your own research, make your own decision. I would suggest split it up, maybe do a little bit of both. And, that would be my thought for you. Let me go back here. Okay, so yeah, the debt to equity ratio. So I would be really careful with this equity ratio, just because with Brookfield, really their thing is, I think, pretty much paying everything. They don't have earnings in the same way that a normal company does. That's why I don't tend to look at the PE ratio, this forward PE trailing. When it comes to this sector, I tend to really focus on the price to book ratio, that the earnings that they have here, to me, it's not a great indicator in the utility sector. Okay, sweet. So there was a question, I think it was from Jenny. Cool. Okay, so yeah, Katruja, my uncle works for Northland. Ooh, here we go. And as far as I know, they're looking at investing in projects, and I believe may already have in Europe and Asia. Don't know the details of the projects though. So yeah, that's kind of my understanding as well, is that it is they are being a little bit more aggressive in terms of expansion, which kind of might hurt them right now if it turns out that the energy requirements are lower and we actually don't need quite as much energy as we thought we did. Okay, Jenny, watch your session yesterday talking about my holding Mergy and why I chose that. Sure, I'm so happy to do that. So basically, when it comes to my personal portfolio, and I should probably revisit it soon, there's this old saying, the barber doesn't always have a good haircut, the barber doesn't cut his own hair, and that I probably don't pay as much attention to my personal portfolio as I should. But when I set up my portfolio, there were no fossil fuel-free options. So I wanted a fossil fuel-free portfolio. I wanted to divest. So I used this fossil fuel-free approach where I went through sector by sector. And basically went through and I was like, thumbs up, thumbs sideways, thumbs down. So for example, industrials, thumbs down for me. That has military. I didn't want that. And for me, financials, I didn't want that. There are a lot of banks in there that for me, I spend so much time complaining about the big banks and trying to undermine them and their business models that, I was just like, no, I don't want to own global banks. But, it's such an important part of the overall economy that I couldn't have zero exposure to financials. So I looked at the global financials ETF and I looked at what are the companies inside of this. And I tried to find companies that I was okay owning. right? So like Berkshire Hathaway, no. JP Morgan Chase, Bank of America, HSBC, Wells Fargo, no. You know, RBC. So the one at the time I looked at the Canadian banks, I was like, okay, Canadian banking sector should probably have a little bit of exposure. When I looked at it a while ago, TD had the lowest amount of investments in fossil fuels among the Canadian banks. I don't think that's the case any longer, which is why I'm a little bit angry at TD, and I'm thinking about switching out of that. As well as I went through here, where is Mergy? It's going to be in here. Here it is. Now, don't ask me to pronounce the German, please. This is why it's referred to as Munich Re. Munich Re is a re. So when it comes to Munich Re, they're a reinsurance company. Reinsurance is a very strange business. They provide insurance for insurance companies, right? So really, like, they're on the hook for large scale disasters. So for example, Fukushima, right, happened, huge, big disaster. All the Japanese insurance companies, they could have gotten screwed if they had a lot of exposure there. So that's why they buy reinsurance to be able to protect against these huge losses. The result is that Munich Re has some of the best climate change risk research on the planet. That they are literally on the hook for climate catastrophe, right? Which means that they understand climate change better than anybody else. And they put out some amazing research when it comes to climate change risk, that they really understand this stuff. You know, Munich Re is a pioneer in analyzing the impacts of anthropogenic global warming and natural climatic variability on losses caused by weather-related natural disasters. So, you know, there's a bit of an irony here, because obviously they're on the hook for climate risk. If we don't solve it, if we don't fix it, and climate change gets worse, they're going to have to pay out a lot of money. That said, I feel like they have a vested interest in solving climate change, right? So they're producing this great risk. They're also doing some other cool things. Let me just see. I think it's under, no, it's, they just updated their website a little while ago, but they do have things that, oh, it might be under company. Give me a moment here. I feel like it was under, no. Sorry, they updated their website and I don't know exactly where it's going to be, but I know that they do offer something called transfer risk solutions. Here we go. Solar energy insurance for the photovoltaics industry, where basically like solar farms can insure themselves against cloudy days. Wind farms can insure themselves against little amounts of wind. By providing insurance to solar and wind, right, what they're doing is lowering the risk of those projects. You lower the risk, you increase the investment, which is a way of supporting more wind farms and more solar farms. So I just really like what they're doing in terms of climate change. From there, let me just show you the financials real quick, just so you can understand kind of, you know, how I look at it. Now, it is a German company, right? So it trades in the US. This Mergy symbol is something called an ADR, an American Depository Receipt. So this trades in the US, and I was able to purchase it. I had to like bug Questrade to let me to buy this inside my RSP. A lot of these things trade on the over-the-counter market, so we have to be a little bit careful, and sometimes they don't like us buying them. But this is a very big company, $25 billion company, very, very large. You know, and that when we look at their chart, we can look at it over the last 5 years, you know, obviously looked very, very steady. And then like all financials, like absolutely everything, it has fallen off a bit of a cliff here. So you can see that my shares would be down quite a bit, you know, from a peak of $30 down all the way that bottomed out at $15.90. It could go lower, who knows? Although, you know, obviously this does take us back quite a ways, all the way back to about 2016. So there is a good chance that this is something that might be a little bit oversold. That said, it's going to be interesting how this whole coronavirus situation impacts the insurance industry. I haven't done any analysis there. But at today's price, it does pay us a very nice dividend of 6.5%. So for me, when it came to financials, what I was looking for were like large, global, multi-billion dollar companies that did pay a nice dividend, that understood climate risk, and that were acting on that. That's why, I'm happy to still own Munich Re today, even though, it has fallen, that this is a position that I might start to increase a little bit as I do my rebalancing. But with TD, I would say they've kind of they haven't lived up to my expectations in terms of how seriously they would take climate risk. So that's why I'm a little bit disappointed there. Hopefully that answers your question. Okay, any more questions here? Okay, I think that's about it. Steve, you've got one. Feel free to bypass. I could go all night. Okay, well, I was a little late to start, so I'm happy to stick on here for another little while. I've never tried Norbert's Gambit, but I'm intrigued. Can you recommend a relatively safe security that you would feel comfortable doing this with? Yeah, absolutely. Oh my God. So the way we do Norbert's Gambit is we use something called DLR. So DLR is a very, very simple, it's the Horizons US dollar currency ETF. So this is not a stock ETF, this is not a bond ETF. This is a US dollar currency ETF. So that this basically, it trades in Canadian dollars, but it tracks the US dollar. So it's the exchange rate. So you can see it's jumped up here over the last little bit, but that's because the Canadian dollar has gotten weaker. Again, this is why I kind of check the oil prices, because Canada is a little bit of a petrodollar. So with the oil price going down, that has made our dollar weaker, which is why this has sort of jumped up. But overall it is very stable, and what's awesome about it is that we also have DLR.U.TO, or they're going to have it .-U probably here. Here it is, the DLR-U.TO. On Questrade it's .U.TO, and this is the same thing but in US dollars. So this is the Horizons US dollar ETF, but in US dollars. Now you can see this is as flat can be, right? Because it's never going to change. The other one, because it's traded in Canadian dollars, is going to fluctuate with the Canadian US dollar. But the US dollar one is going to stay extremely flat. That's the point of it. So when it comes to Norbert's Gambit, and there are lots of YouTube videos. So I would strongly suggest, I have Questrade, but for just about every broker, there are some different YouTube videos. I like this one with Justin Bender. What's pretty cool is that PWL, Capital, Norbert's Gambit, that, I think they have guides, a bunch of these white papers on it. Yeah, so here it is at RBC Direct Investing. But they've got a whole bunch of videos based on different brokers, kind of how to do it at different things. They all suggest using DLR and DLR.U, that is by far the most stable ETF because it is a currency ETF. Did that help? I'm hoping it did. Okay, sweet. Awesome. Okay, great. I think that's helpful. I'm going to call it there, unless I'll give kind of, I'll let the video catch up. I'll give it sort of a 30 seconds on the leg to be able to see if there are any last questions from anybody who is watching. I feel like I did lose a bunch of viewers by being late, so I'm going to make sure that I kind of have everything set up and that it's good to go. I kind of struggled with where to, on the YouTube site, sort of where to click go live. So I'll make sure. I'm not sure when I'm going to do the next one. I'm thinking about doing these weekly just to be able to, have space in this. Oh, thank you, Gal. I missed your question before. I saw this, so thank you for posting again. Should we do the Norbert Gambit thing by ourselves before a meeting because it takes several days to have it in US, or should we do it with you? If you can do Norbert's Gambit on your own, oh my goodness, do Norbert's Gambit on your own. That would make my life a lot easier. It means that we would have currencies in US dollars so that we can just buy things in US dollars. That said, a lot of clients, it is kind of awkward doing it the first time on your own. It's a little bit tricky. So that's why oftentimes with clients, what we'll do is we will do it together for the first time. It means that we need to split up that trading meeting into two. So what we'll do is we'll kind of do the Norbert's Gambit, and we'll do the Canadian dollar trades in the first meeting. And then what we'll need to do is wait about a week for Norbert's Gambit to go through, and then we'll finish Norbert's Gambit, and then do all of our US dollar trades in that second meeting a week later. If you're able to do Norbert's Gambit on your own, if you know how much to convert, and you know all the math and you feel comfortable doing it on your own, that would be amazing if you did it yourself. That said, I don't really expect you to do it yourself, just because it is the first time doing it. That, you know, oftentimes clients really appreciate having me sit there and walk them through the process. So, you know, I completely understand if you want to wait for me. And then what we would do is basically split it up into 2 smaller trading meetings. Hopefully that clarifies. How's everybody feeling? Good? I hope this is helpful. I hope you've learned something today from this. Really, I think I'm going to try to keep doing these, I would say like weekly. I feel that this time, if you can, there is a video on YouTube. If you can do it, oh my goodness, yes. But yeah, I think I'm going to try to keep doing these weekly as long as people like me doing it. As long as there is some interaction and engagement, then I think I'm happy to kind of just do them on Thursday evenings like this. Yeah, and that it is a little bit scary. I get it doing it the first time. This is why I'm happy to walk you through it, and I would expect me to walk you through it the first time. How low can the market possibly fall theoretically? I mean, if it's the big one, it's the big one, and everything goes to zero. So theoretically, you know, the stock market could go to zero if the entire economy absolutely collapses. Straight up, if that happens, then we've got bigger fish to fry. Like, we're in full-on zombie apocalypse, or in this case, coronavirus apocalypse territory. So, you know, I really don't see that happening. If we're talking about, you know, in a prolonged recession, how much further could the stock market fall? You know, really what I would want to do is look at something called the All Country World Index, which does go back quite a ways, ACWI, just to give you a sense of 2008, 2009, which was its own sort of like crisis here. Let me just do the chart. Hold on. Chart. And then I can do the max here. Here we go. So this is to show you sort of how far it fell in 2009. That from a high of this started at $52, $54, down to a bottom of $24. So more than 50%. Now notice that it did bounce back up quite quickly. And, you know, kind of got up there. And then I would say at this point, this was in 2013. So from 2008, and then it took us till about 2013 to get back to where we were, right? In this case, just to show you where we are right now, from a peak of about $81, it's at 57. So we have not hit the like 50% decline that we saw in 2008, 2009. Meaning that it could fall a little bit further, right? The sense that I get is that the market has priced in a lot of fear. And that my guess is that things are going to start to settle down a little bit more, especially as the government rolls out a lot of these benefits packages, that letting people know that the government is there for you. I think central banks and governments learned a lot during the credit crisis that they're now applying to this current crisis. But obviously we don't know. We just don't know, which is why I do want people to be prepared that it could go down a little bit further. That said, what I want to point out is that, you know, in terms of the decline, right, it does decline quite sharply, but it also does tend to jump back up quite sharply. And nobody knows when that bounce back happens. So that's why I would really, really caution you against trying to like time the bottom of the market. And instead what we would want to do is slowly buy back in or put money to work very, I would say, you know, deliberately using this dollar cost averaging. so that we can sort of, buy back in over time. Really what I feel bad for are people who entered the market up here for the first time. It looked fine. It looked like the stock market was doing great, right? And that really there wasn't a huge reason up here to not invest. And if people put all their money to work up here, that would have been a bit of a problem, right? Which is why this idea of dollar cost averaging, I think, is always a good idea. And why, compared to where we were there, if you're just putting money to work now, you are buying stocks at, what is that, about a 35% discount from where they were before. Now, there's no doubt that we were probably in a little bit of a bubble before. So I don't know if that's like the best benchmark to say. I don't know what prices really should be. What a good, a normal price for the stock market should have been. Obviously, if we were, at about this level, the fall that we've had wouldn't be quite as dramatic. But, we do want to be prepared for the fact that it could fall more. Although my instinct is that we have seen the worst of it, that if it does fall more, it probably won't fall by quite as much. The other thing I do want to let people know is that, the sustainable portfolios have been performing really well. So I was just looking at a little bit of a chart. Again, this is my benchmark, the All Country World Index. And I know a lot of my clients, especially if we've, in the last little bit, if you wanted to divest, they own something like ETHI. Let me do the comparison. Here we go. ETHI.to. Here it is. And I'll make this one purple. You can see it had done really well, hasn't fallen by quite as much. As well, I know a lot of clients own SDG, which is the iShares MSCI Global Impact. I'll make that one pink. It's down quite a bit, hasn't fallen quite as much. Again, these things don't have oil, so they haven't been dragged down. There are others that I could use. I could do something like PZD, which is clean tech, which is the green one, right? And you can see this one did, and this one actually has fallen by more, right? So again, not super shocked to see that green stuff has fallen by more. We expect this one to be a little bit more volatile, but if there is a bounce back, this one will probably bounce up by a little bit more. So, things are down. If we look at it over the last couple of years, obviously it's, we can see it was good times, and then really it's just been in the last month or so. And that the hope is that the economy is going to stabilize, things are going to settle, we're going to accept sort of this new economic reality that we're in right now. And that I think there are going to be some buying opportunities, over the coming weeks, months, and years. The trick is just trying not to time it. We probably want to keep putting money in gradually over time. Okay, let's see here. Jenny, thanks, Tim. I had to brace myself opening my Questrade account the last week. Yes, I bet you did have to brace yourself. But keep an eye on things and appreciate these online meetings. That makes me so glad. I think I'm going to keep doing them as long as, markets are super volatile, because I do think that it does help people knowing that I'm here for you. And, let's see how it does. PZD is an ETF. Yes, PZD is an ETF. That's right. That's the Invesco Clean Tech ETF. So that is one of my favorite green ETFs. So it is down quite a bit. Like when we looked at it, it is down a lot. From where it was, but it had been doing quite well for us. Let me just get rid of the other guys, and I can show you just PZD, right? That we can see it was up quite a bit, and that now it has fallen. No, this is funny. Let me get rid of that one. Yeah, that it has come down quite a bit. It's trading at $34 per share, although, yeah, that is right. Whereas before it was like up at a maximum of $50 per share. So it has come down quite a bit, and clean tech, it'll be interesting to see how it does with oil prices being so low. I'm a little worried, that the investments in clean tech might not be quite as profitable as they were when energy prices were a little higher. But again, this is something I'm going to keep my eye on and, hope that it does bounce back up considerably. This is something that we shouldn't have too much of your portfolio in. This is why we only have it as a small bit, because it is such a volatile ETF. Cool. Okay, my pleasure. I'm going to call it there for the night. Thank you so much for watching. If people are watching this after the fact, leave me comments on it. Let's keep this going. I'm going to get better with tech. I'll play with it over the next week, and if there are any improvements, if you think I should improve my mic or any of those things besides just making sure that I do start punctually right at 7 p.m., I'll make sure that's good to go next time. My audio is clear, but the video is blurry. Not sure if that's at my end or yours. Oh, interesting. Okay, so it does let me change this stream latency. So let me see if I can play with. Duncan, let me ask you this. The video is blurry. Is it my webcam or is it what you're seeing on my screen? That'll help me to troubleshoot it. I'm just going to give you a few moments to see whether that does pop up. It's so funny for me having to wait for the lag. I'm so used to Skype. Anywho, maybe I'll play with it a little bit. I'll watch the video and see if I can make some improvements, get a bit more of a clear video. That's very helpful feedback. I do appreciate that. It's both. Okay, so then, I'll play with it. It's probably the way that I'm streaming it. I'll play with the settings a little bit. Thank you so much, everyone. Again, I'm always available by email, ideally with clients if it is urgent. Please text me just because things are a little bit hectic on email right now. But hope everybody has a wonderful week. Tomorrow is Friday, and fingers crossed we get through this week without a huge amount more volatility. This has been a historic week for us, so fingers crossed we can get through there. Jenny, yeah, I hope you do love seeing my face. That's why I'm here for you. We didn't get a visit from my puppy. I took her out for a big walk before the call, so sorry that she didn't come for a visit. Next time, maybe I won't tire her out as much and we'll get a little visit from Irie. Hope you're having a great day. All the best. Bye-bye.